Hey
hmm
guys, I can't be on camera today. I was helping my son move. His last day of college. It was first semester, so I had to help him move. So I'm back and forth, and so I'm unable to be on camera. And Alan also is in a meeting related to Sequoia, and so I'll be running the training today. Today, I wanted to talk about the differences between traditional lending and non-traditional lending because that comes up a lot as far as questions. So I wanted to kind of briefly touch upon the difference between the two. I know a lot of times. Banks are not the answer for the type of clients that we have. We deal mostly with real estate investors. And a lot of times, some agents think that the banks are the solution, and we try to tell them no. We're not the bank. We're not banks. We don't deal with banks, but there are a lot of other creative ways that we can get things done, and there's a market for that. So I just wanted to kind of touch base on that. Okay, wanted to get to the traditional lending versus non-traditional. Katrina, thank you, appreciate it. There's two type of, as you know, two types of lenders in this real estate industry. There is a traditional and non-traditional, different philosophies. Traditional lenders are geared towards avoiding risk, and there's reasons for that. They say no more often than yes, but that's because a lot of times they protect the depositors. They follow rigid guidelines. They're heavily regulated, whereas non-traditional lenders are typically backed by investors who understand risk, and so as a result, they've been able to be a little more creative. Non-traditional lenders are designed to price risk and get deals done because again, they understand what the market needs and what the market wants. Whereas again, banks and traditional lenders are typically going to be more rigid. The majority of real estate investors, which are our clients on the real estate side, do not fit that bank guideline. They don't fit that bank box, and so this is where we come in. Sequoia comes in because we are able to fill that gap where the banks can't. We're able to actually get things done and creates a lot of opportunity for agents because most investors again don't qualify. So this is what creates this great window for us, Sequoia. Um, what is traditional lender? Traditional lender, basically your banks, your big banks, credit unions, all the agency-backed lenders, the Freddie and Fannies. As you know, again, I mentioned heavily regulated because they deal with depositor money. Again, it's the non-traditional because they're backed by investors, and a lot of times the investors they are investors themselves, and so they understand the kind of guidelines that the market needs and investors need. Traditional lenders are governed by a lot of heavy overlays, committees, and conservative underwriting. They're designed basically for owner occupants and stabilized borrowers. They're not really built for speed, as you know. I don't know if anyone's got a bank loan. They're just not built for speed, creativity, or investor strategies. They typically are ultra conservative and very cautious. Now, doesn't mean they're bad. I mean, they offer great terms, and again, if you can qualify for a bank loan, by all means, and you got the time and the ability to do so, that's fine. But again, as far as real estate is concerned, as far as the core agents are concerned, a lot of times the deal needs speed, and so the kind of lenders that we are used to are able to accommodate that. Traditional lending is basically it has a borrower first approach. In essence, non-traditional is mostly asset based, and so they're not too concerned. I mean, the primary focus is not the borrower, whereas in traditional lending, the borrower is typically they're going to look at the borrower first and foremost, and so they're looking for strong credit, verifiable income, tax returns, typically a lot of hoops to jump through, which complicates the files and prolongs the process. There are stick receiving requirements on properties and long approvals, right? Because of the hoops we talked about earlier. Um, there one missing thing can kill the entire deal. We once had an investor with great credit a while back, perfect payment history. They went to the bank to qualify for a rental loan, and they were turned down because a few years back they failed to pay a utility bill for $70. I think they were transferring addresses. That final bill was issued. They missed it. It was $70, and the bank said no, despite I mean, 15 years of perfect payment history, great credit score, great income, the whole nine. So we're able to get them done with a non-traditional lender. But again, these are the things that the banks look at that will actually turn the deal down, whereas non-traditional will actually look to work with that borrower and figure out a way to get it done. Pros and cons, as you mentioned, if you go with the bank or traditional lenders, they're going to offer the best terms. They are going to get the lowest rate, the best term. That's again, but you have to qualify. And it takes a lot. Everything has to be perfect, as we mentioned before. That person's credit profile was perfect, but one thing, and that was denied. And so basically, they do offer the greatest type of products as far as interest and terms, but you got to qualify, and it do take a long time. They take this extremely slow, and it's a document heavy process because they want a lot of things that non-traditional lenders don't really require. For example, tax returns, they want proof of assets, they want a number of things, a host of things. Whereas again, the non-traditional lenders are built for speed and don't necessarily look for those items. There's a high fallout rate. These are the pros and the cons. The cons, high fallout rate as far as borrower frustration. We once had a client that came to us. And unfortunately, we couldn't help him. It was too far gone in the process, but he's looking to buy a multifamily building, and he had gone to the bank initially. What happened is the bank's committee asked for a second appraisal, and because of that second appraisal, even though they had a first one and they had everything looked good, that second appraisal put a delay in that process that actually cost him the deal. By the time he came to us, we couldn't close in time. There was not enough time. So the bank lost him a deal basically. Not only did he lose the deal, but also his deposit. And so these are some of the things that the bank, again, great as far as building a relationship with them, getting those terms, but not so great as far as needing to close fast, and in some cases, just the amount of paperwork and all the hoops you have to jump through. Non-traditional lending creates opportunities, and this is what I was saying earlier, where the banks are unable to get some things done. Non-traditional is able to do it because the underwriting is different. It's more asset based. Again, the banks are typically looking at the borrower and they're looking at the strengths of the borrower, whereas asset-based non-traditional lenders are going to look at the asset first and then the borrower secondarily. Flexible guidelines, and I'd say real world guidelines. A lot of underwriters and company owners on the non-traditional side are investors themselves, so they understand what investors look for, what investors need, and as a result, they don't keep the process bogged down with things that don't make sense. It's common sense at times. Banks are notorious for making decisions that leave you scratching your head. But non-traditional lenders they're creative. They're flexible and they want to get the deal done. You have a much higher approval rate with non-traditional lenders because of that. Because of the creativity in underwriting, there's a lot more deals that you can do as opposed to the bank. And this creates repeat investors instead of one-time transactions. The reason I mentioned that is because we've had many people that have come to us and they're so grateful that we got a deal done that it just referrals and also repeat business. They tell their friends and their colleagues about us and what we're able to do, and that causes us to be able to capitalize on that referral business and not work as hard as creating new business because that we have that in-house repetition and referral basis. Identified a few opportunities over the past, I would say maybe a couple of years, the things we're seeing as far as the deals that are coming to us and the deals that are actually closing and where the banks are failing to a certain degree. I would say number one, bridge to DSCR loans, no seasoning loans. A lot of banks do require seasoning. Seasoning means you have to have owned the title for a certain amount of time, usually between 6 to 12 months. Some lenders, even on non-traditional side, require that as well. But we have lenders who don't require any seasoning whatsoever. A lot of banks require the property to be stabilized and or renovated, like fully fixed up, whereas we can still get bridge loans even if that's not the case. There's no requirement, and the difference also is that a lot of times, even the ones who don't, even the non-traditional lenders who don't require seasoning, they will still operate on a cost basis, meaning, yes, we'll refile you in less than 6 months, but we're going to only base it off of the purchase price or the what you put into it, the purchase price plus the cost to renovate. Whereas we have lenders that will give you the as is value right after you renovate. As long as you can prove you fixed the property and added value, we can actually get the appraised value refinanced. So, and that's refinanced from bridge to DSCR, which allows investors to scale faster, which means if they're paying a high interest hard money bridge loan, they don't have to pay that for long. And also no limits, because banks, another thing they do is they cap you at a certain amount. To my knowledge, it's generally around, I would say 10 is what, I've seen investors come to us and say the bank's not lending me any more money. I can't go to the bank anymore. Can you help? And so I think that's around anywhere from a 6 to 10. But again, the good thing about this, the non-traditional lenders don't report to the credit bureau, so it doesn't count against debt to income. It doesn't show up, and also there's no limit. So you can have 10, 20, 30, 40, 100. It doesn't matter. As long as you're able to service the loan and the properties get that service, you're in good shape. This is a real case study. An investor, I put the numbers up here, but an investor purchased a property below market. This was in Ohio. They bought it for 146K. They used a bridge loan. It was a rehab loan to finance the property and the renovation work. The loan amount was 150 dying. We got them 85% of the purchase price, 100% of renovation. And they got this done fairly quickly. Within 3 months, they actually got the work done. They were actually able to lease it out, rent it out, and we were able to refinance them quickly into a DSCR with no seasoning. So basically, we were able to actually get the property appraised using the as-is value, and we were able to recoup some of their money and actually, just begin to enjoy that as a rental property and move on to the next one. So the agent was able to earn commission on both sides because we were able to handle both transactions. So again, this is something that ordinarily might have been declined by a bank, but on this case, we were able to do it, not just do it once, but twice, because we got the bridge loan business, which was the fix and flip side, and we were also able to get them out of that same loan. So again, the company and the agent made commission 2 times. Another opportunity we identified recently is first-time developers. The banks are strict on development projects, and anyone coming to apply would have to have experience. They have to have the balance sheets. They have to have the credit. It's basically no first-time investors are seen as high risk, and so they pretty much will get declined by a bank. We have lenders that can lend to first-time builders or even allow them to partner with their GC. I spoke to a lender earlier today, for example, that mentioned that as a first-time developer, as long as the GC is willing to sign an execution agreement, meaning that he'll complete the work, and they're able to actually, in this case, be on the LLC, even though it's not required all the time. But in this case, they could be on the LLC. They don't have to sign any documents. As long as they're 20% or below, they can be on the LLC, not sign any documents, which means they're not going to sign as a personal guarantor for the note. But that allows a deal to get done with a first-time developer, first-time builder, which is, again, something that was not the case, maybe I would say about a year ago. Their lenders were not doing that at all. But now as the money is becoming more aggressive and things are getting more, competitive, then there are lenders now that are willing to look at first-time builders. Again, something that the banks would say no to. It doesn't matter what your credit is, doesn't matter how much money you have in the bank. If you don't have any experience with them, they're going to turn it down. Whereas we have ways to get those things done. Now, why private lenders are going to say yes to developers because they focus more on a couple of things. They focus on the land value and the economics, basically. So the credit is important. Not to say that credit is not important. They don't look at credit, but it's a secondary factor. So basically, the big focus is going to be on the actual project itself, and so they're going to basically look at the construction budget, the land value, the after repair value, which is again secondary to the person's credit or income. Loan to value and exit strategy matter the most. What the value is, and also what the risk is. Non-traditional lenders, they're not to say that they love risk, they don't, but they know how to mitigate it and work around it, whereas banks don't. Banks typically, if it's too risky, they'll say no, whereas non-traditional lenders will actually figure out ways to get things done. So risk is priced, and so it's mitigated. So they might charge a higher interest rate. They might charge more points. They might lower the leverage. They might do a number of things, but they figure out a way to get comfortable with the deal as opposed to saying no. Deals are structured to protect the capital. So again, they're basically looking at, we'll do the deal, even if you're not experienced. But here's the thing: we're going to lower it. Instead of giving you 80%, we're going to give you 65%. So anyway, they adjust according to the risk. The better the better the borrower, the higher the leverage. And so, in essence, they won't say no, but there are things they will do to adjust instead of declining the loan outright. Another opportunity that we found are fix and flip loans because banks, they will not do fix and flip loans. They'll do not do renovation loans typically. There is a 203K product out there that is a rehab loan, but it's typically for owner occupied properties. It's not an investor product. It's more an owner occupied product. So there are rehab loans, but you have to live in the property, which is good if you're getting a 1 to 4 unit. You're gonna live in one of the units and renovate the other three, or if you plan to buy a house that needs a lot of work and live in it. But in case this, we again, our clients are investors, real estate investors. So this is out of the window. So banks, again, for as far as fix or flip, is just not a good choice. Private lenders specialize in fix or flip financing. And again, this is we fill the gap. Now, banks love properties that are fully renovated. So once a property is renovated, absolutely. If you've got great credit and if the property cash flows well, then by all means, they'll do it. But if it's not, then what's going to happen is you're going to need a bridge lender or a fix and flip lender who's going to give you the money to renovate it. And they understand the need for speed. Fast closing are critical because, again, if you're putting in an offer, you're competing with multiple potential buyers. You have to be able to say, I'm going to close quickly. And so, again, with the bank, even if they were able to do it, that timeline between 30 to 45, maybe 60 days would just not work in this business. So fix and flip lenders understand the need for speed and are able to actually move pretty quick as opposed to the banks. Some options we've able to work on. We're working on currently on a couple of these. You've heard me mention 100% loans before, and so there was 100% of purchase, 100% of renovation, no monthly payments. Issue then the borrower must qualify, so you have to have a 680 or a higher credit score in most cases, and have some projects under your belt. So there is a level of qualification, but there is something that could be done. So there is a 100% program that's available. There's also quick no appraisal loans we have, where lenders pull their own comps from the desk and basically give you a guaranteed loan amount. The reason this is great is because a lot of times what happens when the appraisal comes back, if it comes back low, then the loan amount has to change. It's adjusted, right? And so you're kind of holding your breath waiting for the appraisal to come back. Whereas with this type of lender, it's going to be, they're going to determine what the values are. They're going to give you their term sheet up front. And basically, there's no guesswork. It is what it is. It's going to stay the same no matter what. Unless there's something, of course, that comes back on your credit report or background. But barring those things, the loan amount's going to stay the same. We do have a couple of new options here. There is a no minimum credit score fix and flip product as long as the ARV. As long as the purchase price rehab do not exceed 65% of ARV, then the credit score is not consideration. So basically, there's 100% funding available here, but that means that you're buying at a great price. So it's in essence the purchase price and the rehab budget fall under 65, then that potential to get this 100% funding is here. Now you have to have experience. If no experience, they're going to basically adjust the leverage and maybe give you a lower loan amount. So you do have to come out of pocket with money to close, and you do have to carry the note. You have to pay monthly payments, interest only. But again, it's a great way to get into property if you're able to purchase under these parameters. The last one is a joint venture opportunity, which is relatively new. It basically involves, we've had conversations with different investors over the past few months, and they're open to coming in to a certain degree as partners. And so there's a profit split at the back. So basically the way it works is you find a great deal, you don't have the capital to work it, they'll come in with the cash to do it. And every joint venture is a little different. So it's not the same formula because there are different investors involved. But the bottom line, I guess, if we extract the common ground here from all these conversations, is that they're looking for high equity, low LTV type deals. And so if the purchase price and renovation don't exceed 70%, even better if it's 65 or lower, but if it doesn't exceed 70%, then it's a good candidate for that type of thing. And we can actually discuss that. So if you have opportunities, or if your clients have opportunities where you have someone that doesn't have any experience or terrible credit, but has found a great deal, which happens once in a while, then we'd be able to talk to them. They may not qualify for any of the ones above as far as 100% or the no appraisals, but there might be a chance to partner with an investor who may be able to get them across the finish line. Opportunity number four is we find rural and non-conforming properties. A lot of times, rural properties just do not fit the guidelines of the bank. Large acres just create a whole bunch of issues as far as this is a whole bunch of I would say nonsense, but just things that again don't bode well for the person looking for that loan. The non-standard properties, things that don't quite fit the back box, get declined automatically. Again, we are able to, because of our network and because of the lenders that we know, we're able to get some of these loans funded. We just priced out a loan today where it was a rural property that sat on 6.7 acres. Most lenders would do rural would cap this off at 5 acres. This was 6.7, so this was above the 5 acre limit. But we're able to find pricing for that particular scenario. We're waiting for the borrower to get back to us. But again, this was turned on by many, many lenders. And so we were able to actually find this financing for him. So what we again try to stress is that rural non-conforming properties, there's still a home. If you have clients that just again don't fit the box for the bank or just have a hard time finding a home for a deal, again, bring it to us and we will talk to our funders and see what we can do. Option number five is it's always been the case, the need to close fast. Again, I go back to traditional lending. The banks will take around 45 to 60 days, if not longer, sometimes even longer than that. And these delays cost borrowers. Like I mentioned in the previous example with the gentleman that had that property in the contract, lost it, not just lost the deal, but lost his deposit. So the EMD was gone. And so ultimately, in this real estate industry, things have to move very, very fast. And so the private lenders are able to close fast in a little less, maybe 5 to 21 days. And that depends on the scenario. 21 days being maybe on the DSCR side, on fix and flip, maybe a couple of weeks. But again, if they have to move quicker than that, we have options for them to move fast. And so, again, this is something where the banks are notoriously slow, can't get things done, will cause deals to go south, whereas we can actually get them done. In some cases, even save them. Unfortunately, we couldn't save the gentleman I was talking about, but we have saved a lot of deals where the banks or the other lenders are being slow. We were able to step in and get things done. The quickest loan for the record has been closing a deal in 1 day. We got the loan application I think Wednesday, and by Thursday or Friday it was closed. I think it was Thursday. Literally 1 day. The next day we were able to close. So again, that's an anomaly. That's not going to happen all the time. It's not something that is done. It happened once, but just again to show that it's very possible that this speed can be achieved by using private lenders and non-traditional lenders. We are able to save a deal. And going back to what I was talking about, a client did come to us once with a property under contract. They had started the deal with the bank. This was had a good outcome. This one was actually, it wasn't an appraisal. It was just the bank was just taking so long. I mean, they just kept delaying the process. They were requiring paperwork. They were requiring one thing after the other, and basically it was getting close to that timeline. The gentleman didn't want to take a chance. He didn't even want to ask for an extension. Typically, we asked investors, "Hey, just try to get an extension with the seller." He just didn't want to do that. He just said, "Look, can you guys do this?" And we said, "Sure." We went and took a look at the deal, analyzed it, sent it out to a couple of our funders. Within 24 hours, we had a short-term bridge solution for him, issued terms, coordinated directly with the title company. Actually had conversation with the seller too, letting him know, "Hey, things are working on this end. It's going to close. Just give us a little bit of time," and we're able to actually do that. So Speed in these cases is more important than rate. And also a great thing about these kind of deals is there's less negotiation done because the deal has to close. And so instead of somebody griping about points or interest rates, they just want it done. And so there's again less pushback on pricing, which means in essence more money. You're able to charge a little bit more than an average deal because you have to get it done so quickly. And and investors are typically less prone to argue or to dispute or to fight about points and rates. Option five is the low credit, high equity deals, kind of what we talked about on the joint venture side. But again, banks focus heavily on credit scores and credit history. Now with AI, it's typically a decline based on just the person's profile. It's done fairly quickly. The volume of business that comes to those banks and their ability to automate the system, it makes it very turning down is very likely and very very frequent. Private lenders typically will underwrite things according to common sense underwriting guidelines. They look at equity, look at collateral, they look at the borrower. A lot of times, strong equity can overcome weak credit. So weak credit is one thing, but if there's a high equity, there's a lot of equity in a particular property or project, there's a tendency to kind of turn the blind eye to whatever that is. Again, not to say that it's not to say they don't look at credit or don't look at the profile, but that is secondary in regard to what the equity is. Um, Non-traditional funding means less competition and more closings. Basically, there's fewer competition. Less people are able to actually get this done. You have companies that advertise a lot of things sometimes, but can't actually execute. Whereas again, we pride ourselves on the ability to get things done, and we know a lot of lenders that can. Can we close every deal that comes our way? Absolutely not. Any lender or broker that tells you they can is lying. We just can't. It's just sometimes deals don't make sense, right? So we just can't get them done. But again, the big dollars are going after the prime, the A paper clients, and a lot of times those are the ones that get a lot of attention. So, or the great, everyone wants the best products out there, the ones that are again high equity, great credit score. But we work with less than perfect borrowers, which is great because again that puts us in the lane where that's other than less competition. Um, because they're difficult deals at times, the less rate shopping, borrowers are more prone again to want to get a deal done as opposed to argue about points and fees. And there's a higher closer rate. And I'm going back to banks again. High closer rates and client loyalty because the banks again they're typically geared to say no. They're very guarded, and we understand that. Again, we go back to them being backed by depositors, a lot of oversight, a lot of government regulations, a lot of things that they're very conservative, whereas non-traditional lenders will actually uh, look at things differently, are not able to actually execute on deals that the banks can't. And also, what that does is that creates trust, that creates dependability, that creates repeat customers. So that's basically as opposed to trying to get that client in house you're actually able to get referrals and you're able to actually one client can actually refer 5, 6, 10 other people and you're not wasting or spending advertising dollars chasing just one or two scenarios. And ultimately why this all matters for Sequoia agents, well, I mean, you have access to non-traditional capital sources that a lot of people don't. I always say, even if you go online now and because again, there's a lot of lenders online. You can go online and find lenders, but do they have the same relationships that we do with them? Do they give them the volume that we do? I mean, there's a lot and also a lot of these private lenders don't advertise or don't push. I mean, they may have websites, but again, they're not all, you're not going to be able to find them easily. So again, we have a list of private lenders, a list of lenders for every scenario, whether it's a single family home, whether it's a multifamily, whether it's mixed use, whether it's land, we were able to actually find the right funder for it because we have experience with that. And also we are able to screen a lot of lenders. The story I'll tell real quick is we've had scenarios that people have come to us because they pay these large deposits to these commercial lenders. And so they went online, found a lender charged wanted 20,000, 30,000, big dollar amounts that they put down. Ultimately, come to find out that lender couldn't get it done, and they couldn't get their money back. So those are things we try to avoid. Not to say that those deposits aren't required at all times, but if they are, there's a better chance to become Sequoia that we know the lender. There's a relationship there. We trust them. It's not a guessing game, and so that also helps out too. We offer back support and deal structuring. So again, you all you have to do is get the deals in the door, bring them to us, get hit the street, get deals in your portal, and we're able to actually get those done. We're actually able to structure them so you can focus on your relationships, focus on the marketing, focus on bringing deals to the door. Don't have to worry about underwriting. If you want to be involved, by all means, we'll keep you in the loop. If you have any questions on your deals, happy to answer them and tell you kind of what the lender's thinking, so you can learn as well. But you don't have to focus on underwriting. Your main job as a Sequoia agent is to just bring deals in the door, and we take it from there. And also, again, John, want to elaborate on the confidence side, because once you're able to close deals and your clients see that, then it creates trust, and you're able to, and not just the simple deals, but some of the more complex ones. I go back to, we're not going to be able to close every single deal that comes to us. That's just not possible. But we have closed a good degree of deals that were hard to do, difficult, had been around the block multiple times. We're able to actually find homes for them. So that again creates value, and that creates trust and confidence, and that creates again a money stream for you guys. So definitely, if you have those kind of deals, or if you have any deal whatsoever, please feel free to reach out to us. My contact information is right here. My phone number, email address. You're not alone. Um, we provide infrastructure and expertise so you guys can perform at a higher level. Again, not being bogged down by unnecessary paperwork, unnecessary processes. We will take care of everything. Just bring us the deals, and we'll let you know if we can do them or not. If it's got legs, if it doesn't, and then we'll be able to move forward. And if you want to learn, by all means, we're able to actually keep you in the loop. Some agents prefer to be copied on everything. Some don't. Again, you have to let us know what your preference is, but we're more than happy to accommodate that, whatever it is. Okay, that being said, thank you guys for participating. If there are any questions, please feel free to reach out either on mute or through chat.
Hello, George. We do have some questions from the chat box. The first one is from Peter. He's asking, what are the terms for the bridge loan?
The original, I'm gonna give a general pricing, because it really is specific to the property. It's specific to the investor, meaning the credit score and the profile and all that. But generally speaking, nowadays you're looking between in the teens, between 10 to about 13% on average. That's going to be, again, you might find something lower, a little bit higher, but that's going to be the general framework as far as interest rates. On the point side, and anywhere from, again, it depends on the complexity, the asset, and everything else. But you're looking at between 10 to 13%, anywhere from 2 to 4 points, and anywhere from 60 to 70%. Again, depending on the scenario. Again, these are all just general numbers. We can go lower, we go higher, but those are kind of general terms as far as the bridge loans. And 12 months. It's usually 12-month terms.
Okay, and the next question is from Michael. He's asking, do you finance solar farms? What does Sequoia need to put this together?
Yeah, we do we get involved with solar farm. Alan is the best person to speak to, so I suggest if you want to find out more about that, give him a call or send him an email. We're able to get involved in those, but that's not a typical real estate transaction. I handle mostly the real estate, small balance commercial, 1 to 4. What do you consider traditional real estate? Solar farm is a little bit different, but nonetheless, yes. To answer that question, yes, but do speak to Alan about that.
And the next question is from Benny. He asked, what product do I submit a first-time developer loan under?
Well, developer is going to be new construction, so you're going to new construction, and that's something I have to offer everyone here. If you have a scenario you want to talk about before filling out the form, feel free to reach out to me, either phone or email. But on a new developer, it's going to be new construction, and there's going to be a field that asks for experience. You would just put zero experience, and in the notes, just put first time home builder, first time developer, and we'll know what to do with that one.
Okay, so we have no more questions in the chat box. So
So,
anyone else have other questions? You can just unmute yourself and speak up for yourself. Yep. Anybody else have questions?
So as far as that solar situation, I need to get in touch with Alan about that. And what's the email? Because I mean, like, what kind of structure would you need? You know, I mean, does the builder or the solar provider I deal with Solero, and they are a company that sets up the panels. They do EV stations. They also, you know, I mean, however you want to do it. But I'm saying, what I need to put Solero in touch with Alan to say, okay, this is what the structure looks like. This is who we're selling the power to, and this is what we're making. I mean, is that what I need to do? I mean, or would
I'm,
Alan go ahead and take the horse by the cool legs, as they say?
yeah, it all depends on how you want to move forward. But I would suggest you schedule a call with him, and if you go to his, and if you want to email me your information, I'll be happy to reply with the calendar link to set up a meeting with him. That way, you can discuss that with them personally, and then from there, figure out what strategy you want to employ for this particular project. But well, it comes down to you and what you're comfortable with and what you guys discuss. So again, I'll leave that to him to address. But I definitely recommend setting up a call with him so you guys can talk about it.
Good deal, good deal, good deal. Thank you so much.
Absolutely, my pleasure.
Do we have more questions? Anybody else? So if no more questions, I think we will just stop here. Yeah,
Thank you, Katrina. I appreciate it.
thank you,
Thank you, everybody.
Joseph. Thank you, everyone.
My email's there and phone number. If questions do come about later on, please feel free to reach out to me. Be happy to address them as they come in.
Great, great. Good evening, everyone.
Thank you. Have a good night. Bye bye.
Bye bye.